If you're military and using your VA loan to buy in San Antonio, there are a few myths that could literally cost you thousands of dollars. And most buyers do not think about these things until it's too late. I've helped a lot of military families relocate to San Antonio, and I see the same mistakes over and over. And to be honest with you, I have made plenty of these mistakes myself when I was first using my VA home loan benefit. Today, I want to break down the 4 biggest VA loan myths and what actually kills deals. All right, guys, myth number 1, sellers don't like VA loans. The reality is sellers don't reject VA loans. They reject weak offers. When sellers say, we don't want VA, what they often mean is, we don't want risk. A weak offer usually looks like low purchase price, maximum concessions requested, no appraisal gap, minimum earnest money, long timelines, contingencies stacked on top of each other, so forth and so on. From the seller's perspective, that feels fragile, and fragility makes them nervous. Here's the key. A VA buyer can absolutely submit a strong offer. Strong doesn't mean reckless. Strong means clean structure, reasonable concessions, competitive price, clear timelines, confident presentation. In many cases, a VA buyer with a well-structured offer beats a conventional buyer with poor strategy over and over again, because it's not really about the loan, it's about the strength. You see, poorly structured contracts is where agent experience really shows. VA loans have specific components that must be handled correctly. The VA, a mandatory clause, appraisal language, repair negotiations, seller paid closing cost caps, timeline alignment with underwriting. If these aren't explained clearly to the listing agent upfront, confusion happens, and confusion kills deals. All right, here's a quick example. If you write an aggressive concession request and don't explain the net benefit to the seller, the offer looks sloppy. If you write a high price to offset concessions, but don't evaluate the comps properly, you risk appraisal failure. If you don't prepare the seller for possible NPR repair items, they panic when the appraisal comes back. This is all poor structure. Poor structure creates friction. Good structure builds confidence. That's the difference. Talking about agent experience, guys, this one matters. And I'm not talking about an agent whose brother or grandfather served back in the day. I'm talking about experience. A lot of agents don't specialize in VA. They don't know what homes are likely to pass NPR. They don't prepare listing agents before submitting offers. They don't manage timelines correctly. They don't negotiate strategically. And here's what happens. The listing agent senses uncertainty. Uncertainty equals risk. Risk equals rejected offer. But on the flip side, when an experienced agent calls and says, hey, I've walked the house, I'm confident it meets VA standards, my buyer is solid, we've reviewed comps carefully, here's why this offer makes sense. That changes everything. Now the seller isn't reacting to VA, they're reacting to competence. A VA buyer is often one of the strongest buyers in the market. They have stable income, guaranteed financing, no PMI, conservative underwriting. When I call a listing agent, I don't say, hey, I've got a VA buyer, and just leave it at that. No, I explain why my buyer is solid. If your offer is structured well, VA is not a disadvantage, guys. Poor strategy is a disadvantage. All right, guys, let's talk about myth number 2. Always ask for maximum seller concessions. Yes, the VA allows up to 4% in seller concessions. But just because something is allowed doesn't mean that it's strategic. Sometimes asking maximum concessions weakens your offer immediately. Let's say you offer $500,000 and ask for 4% back. That's $20,000 in concessions. To the seller, your offer isn't $500,000, it's $480,000. That's what it sounds like to them. If another buyer comes in at $495,000 and only asks for 1%, the seller's netting more money with the lower priced offer. You just lost, not because your VA loan, but because of how the offer was structured. Now you're back in the market, rates have shifted, inventory may have tightened. That delay alone can cost you thousands of dollars. Now, some buyers ask for maximum concessions in other ways. They try to build in concessions by inflating the contract price. For example, they'll say, let's offer $510,000 or $515,000 and ask for $20,000 back in concessions. Now, I have structured deals like this before in the past, and that's because it worked for both the buyer and the seller in those particular situations. But that only works if the home actually appraises at $515,000 or $520,000 or whatever the offer price is. If it comes in lower, which absolutely can happen. Well, now you created an appraisal gap. And with the VA loan, you can't just ignore the appraisal. The seller doesn't have to lower the price. You may have to bring cash, or you might just have to walk away altogether. And this was all because we tried to max out concessions instead of structuring the deal intelligently. Just another thing on this point, asking maximum concessions can also signal financial inflexibility. Listing agents read between the lines. When they see zero down, max concessions, no appraisal gap, they sometimes assume the buyer doesn't have reserves, even if that's not true. When I was on the police department, one of the things that I learned in negotiation school was that perception matters in negotiation. If the seller believes you're stretched thin, they're less likely to take your offer, negotiate repairs later, work with you if something comes up. That perception can cost you the house. Now, I don't want to beat a dead horse, but let me just give you one more example. Let's say again, you ask for 4% upfront. Then inspection reveals roof concerns, HVAC nearing end of life, minor foundation movement, which is very common here in San Antonio. The seller's mindset becomes, we already gave you $20,000. Why are you asking for more? Now you have less room to negotiate. Instead, if you had asked for 1 or 2% strategically, you still have leverage left when it matters most. All right, the third myth of the VA home loan is that VA appraisers kill deals. This myth survives because when a deal falls apart after appraisal, everyone always blames the VA. But the VA appraiser isn't trying to kill your deal. They're doing two things here. They're determining value and they're checking minimum property requirements, or MPRs. That's it. Now let's talk real quick about where people get this wrong. Number one, the VA appraiser isn't stricter. They're protective. VA minimum property requirements are about safety, structural integrity, and livability. They're not aesthetic. They don't care about granite countertops, paint colors, design choices. They care about, is the roof functional? Are there exposed safety hazards? Is there peeling lead-based paint on older homes? Are there missing handrails? Is there visible wood rot? Here in San Antonio, especially older homes on the east side or south side, or 70s and 80s subdivisions, these pop up. That's not the VA being difficult, that's deferred maintenance being exposed. Number two, value is the real trigger, not the VA. Most VA kill the deal stories are actually appraisal value issues. If a home is overpriced and the appraisal comes in low, people blame the VA. They always do. But here's the truth. A conventional loan with the buyer who has no appraisal gap, they would have the same issue. The VA didn't create the problem, the pricing did. In fact, the VA appraisers often come in very close to market when comps support it. The difference between VA and other loan types is VA doesn't allow buyers to waive the appraisal safety net recklessly. That's protection, not weakness. Number three on this point, guys, I want to make this very, very clear, is that repairs don't kill deals. Poor preparation kills deals. Again, here's where experienced agents make the difference. If I walk a property and I see peeling exterior paint, rotted fascia, missing handrails, we already know that those things are going to come up, right? We already know that. So either we negotiate the repairs up front or we don't write the offer. What ends up killing the deal is when the agent didn't evaluate the property properly, the seller wasn't prepared, the listing agent wasn't educated on NPR standards, then the appraisal comes back and everyone panics. That's not the VA killing the deal, that's lack of preparation. All right, guys, the last and final myth here is going to be zero down means zero out of pocket. Now, sadly, this was me when I first bought my first home using my VA. I was young, I was broke, and when I was told that I still had to come out of pocket, man, I panicked for a little bit. Now, luckily, I bought new construction and the builder covered all of my closing costs. So I literally didn't have to come out of pocket. However, if they had not been willing to cover closing costs, man, I don't know how that first transaction would have worked out. I'm just being honest. The point is, you still have upfront costs. Even with zero down, buyers typically still pay for earnest money, option fee, inspections. And don't forget about your moving expenses. Sometimes lender required reserves. I mean, that's the thing as well. Now, earnest money is credited back at closing, so you do get that back, but you still have to front it. And we all know during PCS moves, Cash flow matters, and expenses, they add up quick. Flights, temporary housing, renting a truck or U-Haul, whatever the case is, those expenses really add up quick. Now, talking about closing costs also still do exist. Even if you negotiate seller concessions, there are still title fees, escrow fees, prepaid taxes, prepaid insurance, HOA transfer fees. Sometimes concessions cover everything, right? But sometimes they don't. That gap is where buyers get caught off guard, like I almost did. And if rates change or pricing shifts mid-process, numbers can move. You have to be aware of this, which is why planning matters. Zero down doesn't mean zero financial strategy. All right, guys, those are the 4 myths that you need to be aware of. I hope that this video brought you value. Listen, if you are in the military and you're relocating to San Antonio and you're buying soon, don't let misinformation cost you thousands of dollars. The VA loan is one of the most powerful benefits that you've earned, but it must be used strategically. And when it's used strategically, VA buyers like us, we always win. Guys, make sure you hit that like and subscribe button. And again, if San Antonio is on your radar, you're moving here within the next 30 to 90 days or beyond, let's talk. My contact information is down in the description. I would love to assist you and your family making a smooth move here to the Alamo City. We'll catch you guys in the next video.